Hi, this is Gary. In this video I'm going to cover what creative destruction is and try to explain it in as simple as terms as possible. What I'm going to do is I'm going to briefly walk through the history of creative destruction, and then I'm going to explain how the concept of it and how it works in practice. Let's go ahead and get started on the history portion here. Now this man right here, he wrote a book in 1942. It was called Capitalism and Socialism in Democracy. And I'm going to take a quote from that book, which I've got listed in yellow below right here. Now I'm going to highlight the key points, and the key points are that creative destruction comes from entrepreneurs that create new consumer goods, new methods of production or transportation. It opens up new markets, and then new forms of industrial organization, and that's what the capitalist enterprise creates. In other words, you're innovating and stuff like that. Now, those ideas weren't his own. They were tailored to be his own, but he got them from reading lots of books and stuff. And one of the guys he read was this gentleman right here, who wrote the major economic cycles in 1925, like K-waves and stuff like that. And then another gentleman, he got that from here, was the author of Das Kapital in 1863. And that was published, I think his original work started in like the 1840s, so that was after 15-20 years of work, so his ideas were a little bit refined. And then he took those ideas and then in 1942 and then refined them, and that's what's been used by economists since then. Now that we've gone over the history, I'm going to cover the concept of how creative destruction works. What you have is an existing firm or existing firms, and then you have an existing market. Now typically that market is their core market. They are well positioned in the market. They've worked hard to get into that position. I don't want to say monopoly, but sometimes it can be close to that. They are profitable, and I'll put a question mark by the term mature market. Because it's usually mature, but it could be somewhere around that stage in terms of growth. There's not a lot of growth, but there's not a lot of decline. Again, it depends. But their existing market's pretty big, and it's a huge cash cow. Well, all of a sudden a new technology or new innovation or even a new product comes along, and that creates a new market. However, if you look at this picture right here, you'll notice the existing market is a lot bigger than the new market. And if you think in terms of being a large business, it's more profitable to stay in the existing market than it is to cater to the new market, because you got to spend resources, you got to develop stuff, and then you got to compete, and you're competing for this really, really small pie, whereas your current cash cow is the existing market. Why give that up? Doesn't make sense. So while the existing firm may be aware of the new market, it is generally more profitable, especially in the short term, to cater to the old one. Now it's also going to hurt the existing market, as I've covered in yellow there. But while the existing firm or existing firms have constraints, an innovative entrepreneur can come along and not have those constraints, and what they'll do is they'll start catering to the new market. They got new capital for investment. They offer investors a high rate of return on their capital, which makes it attractive to them. I mean, it's risky going into a new market, but if you can make 30 times your money or 100 times the money you invested, or even 10 times the money you invested, it becomes worth it. And the innovative entrepreneur does not have any constraints, or has much less constraints than the existing firm does. And they're typically, they're not going to come in and target the entire existing market as it is. They're going to find one segment that they think they can be profitable on, and then build off from that over time if everything works out. So this existing market's not instantaneously going to go away. Not everybody wants to switch. You have high-end consumers, low-end consumers. They have a cost, and they're typically not going to tell the existing firm that they want to switch right away. And people just don't like to make changes. I mean, once you get comfortable doing something a certain way, it becomes kind of a pain, or it's not the easiest thing to do to go ahead and make changes. So this existing market is going to stay around for a while. It's not going to disappear. However, the question is, what happens over time? And this is a gradual change. Well, let's take a look here. Well, the innovative entrepreneur goes to the new market, and they meet the needs of the new market, and it becomes a wealth creator for them because it's growing at a high rate. While on the other hand, the existing market is slowly shrinking. So over time, the new market grows and gets bigger, while the existing market starts shrinking and starts shrinking more. And then all of a sudden, the existing firm is having problems because their cash cow is shrinking. And then that leads to problems like they might go bankrupt, layoffs. Can they adapt, or do they have to exit providing those services? Because, okay, let's say you have 2 or 3 existing firms in a market. Well, if that market shrinks by as much as this picture shows here and becomes an old market, well, now you're going to have a shakeout where it can only support maybe 1 firm, and it can't be as big as the firm. Like originally you had 3 firms. Let's say you had 3 firms. Well, if the market shrinks a lot, it maybe can support 1 or 2 firms, and they've got to be a lot smaller. So that creates problems. And the innovative entrepreneur in this case, it might not usually just be one, because that can be competitive too, but whoever ends up winning that category, they get their wealth out of the new market, or catering to the new market's needs. So basically, in a nutshell, what happens is you have a new market that creates new wealth or new revenue, and then the old market shrinks, and that will obviously affect the companies. If they have publicly traded, it will affect their stock prices. You might see companies cater to the old market, their stock price might drop a lot, and then the successful companies that cater to the new market, their stock prices will go up a lot. Okay, before I finish up this video, I'd like to give a couple brief examples of how this might take place in the real world. One example could be the post office. Think of the U.S. Postal Service and the introduction of what email meant to their business model. Now, they still deliver mail, and there's still demand. Like one of their new markets is people that ship stuff on eBay. But overall, their market is shrinking, and they have to make changes in order to adapt to that. And we'll see more of that in the future. The other example is newspapers. Now, if you think to like 10, maybe 20 years ago, how much ad revenues a newspaper would generate, now that market has shrunk. There's still some newspapers printing. They've had to significantly cut back. There's been consolidation in the industry, and where a lot of the ad revenue has gone are to like internet advertisers and stuff like that. So there's still people that advertise because you have to market, but in terms of advertising in newspapers or magazines and stuff like that, that market has shrunk. There'll still probably be a market there because people like to read hard print, but it's definitely shrunk, and probably will shrink a little bit more, and you'll see a shakeout in that industry. This pretty much concludes our tutorial. If you have any other examples you'd like to list below to enhance the viewership, please feel free to go ahead.